Hello and welcome to BloombergQuint. It's the day of the Reserve Bank of India Monetary Policy Review, and it's been an interesting one. The RBI kept interest rates unchanged at 6.25%. That's the benchmark repo rate. But there were other important takeaways from today's policy as well. Let's run you through those big takeaways. Like I said, no change in interest rates, but perhaps the more surprising part of the policy decision or the policy statement was an indication that they may be done with interest rate cuts, at least for now. So there was a signaling of an end of the rate cutting cycle, which actually jolted the bond markets in particular. On inflation, the RBI very clearly, or the Monetary Policy Committee very clearly said it's committed to bringing inflation down to that 4% midpoint, although they didn't give a clear timeline within which they hope to achieve that. Growth, they do anticipate weakness this fiscal, bringing growth down to about 6.9%, but they expect a rebound to about 7.4% next year. Apart from that, there were a couple of important non-economic takeaways. One was that all cash withdrawal limits will be lifted by the 13th of March, which means that the remonetization process will be near complete. And a bit of a surprise comment coming in on the issue of a bad bank, which the RBI has opposed in the past. This time around, the RBI top brass suggesting that they're at least open to that suggestion. Talking about the economy and the rate decision, we've got with us Gaurav Kapur. He's Chief Economist at IndusInd Bank. Gaurav, thanks so much for making the time and the effort to join us here. Gaurav, first things first, the rate decision. I think it was a split market, so not everybody had expected it, but some had.
Yes, I think in the run-up to the decision, I think there was, clearly, especially after the December move, I think there were some noises or voices in the market which said that maybe at this stage, does it really help? Monetary transmission through MCLRs has already happened quite rapidly.
Absolutely.
And will it be a wasted opportunity? And I think even for that matter, the swap market was only pricing in a 20% chance of a cut. So not entirely unanticipated. I think fairly, considering the uncertainty which the RBI has to deal with, especially on the impact of demonetization and remonetization on growth and inflation.
Yeah.
And the emerging risks which they highlighted very, very clearly in the policy statement. I think maintaining a status quo was a prudent move, especially considering that we are anyways towards the end of the easing cycle. We've already seen we've seen 1.75% cut in policy rates. We are, and with monetary policy becoming increasingly, or the challenge of moving to that 4% rate of inflation becoming increasingly difficult, or especially in terms of risks. The main risk being the fact that core inflation remains sticky, has been fairly...
It's at 4.8%,
It's at 4.8, 4.9%, has been sticky around that level, and that's something which RBI pointed out even in December. So I think all considered, a fairly... the only surprise, of course, is
the fact that the change
the wording
in stance,
from accommodative to neutral, which in my reading again is acknowledgement of the fact that we are close to a cut cycle. Anyways, I think going into the policy, my assessment was another 25 basis points cut and we are done. But it also is a reflection of the fact that when we were looking at inflation, when we were trying to control inflation, and when it was largely driven by food prices, it was, and to some extent fuel price correction helped as well in bringing inflation down. It was easier to bring inflation down from a level of 6.5%, 7% 2 years back to a level of 5.
Now hence 5 to 4 is the problem.
5 to 4 is the problem. Though the band is between, you have the space between 4 and 6, but I think RBI wants to move towards that 4% level and is preparing the ground to do that.
But the bond markets were clearly not expecting it. It was quite a whiplash in bond yields today.
10-year bond yield went up by almost 30 basis points.
Yeah.
I think it was not, as I said, I think there was an expectation that after not having done the obvious in December, and December was a status quo as well. And with inflation largely moving along the expected lines, especially in terms of the March 2017 target. The target is 5, you're likely to finish around 4 on a more conservative side. And inflation over the next couple of months is to some degree, because of the base effect, is looking that it may actually come down even more. RBI has provided a range of 4 to 4.5%
for the first half
for
of
the
next
first
fiscal.
half.
So they're saying that when
So,
you hit April,
yeah.
you'll probably be around 4ish.
Yeah, 4ish, yeah. So given all that, I think, and given the fact that the RBI wants to maintain real rates between 1.25 to 1.75, I think there was room for 25 basis points cut. But then the counter argument to that is the transmission has already happened.
Yeah.
Shouldn't they be waiting to see how the uncertainty around growth and inflation resolves once remonetization is done, and maybe in the next couple of quarters you will have a better sense of where we stand in terms of both growth and inflation, and the global environment, which is at this point in time is characterized by rising oil prices, metal prices, rupee being under pressure with a rally in the dollar against all major Asian currencies. So I think it definitely came as a surprise for the bond market though.
Yeah, but you're talking about transmission. I'll come back to growth in a minute. But interestingly, the RBI governor said that transmission is not complete because the weighted average rate is down only about 85 basis points compared to 175, which is the RBI rate cut. But that's actually not the case.
I believe so. I think I agree with you on that, because if you see the MCLRs, especially since the 8th of November, there has been a sharp correction there. But I think he did mention that depending on the profile of the borrower as well.
Yeah. Okay.
So MCLRs have come down, but perhaps the spreads have not come down as much. I mean, that seems. But definitely, there's been transmission.
There has been transmission.
There's been, especially since the demonetization exercise started.
Just a little bit more on the inflation side. So, what is your expectation on how inflation shapes up next year, and what are the factors? I mean, oil obviously would be one, but how did this whole remonetization process play into inflation?
It will. Demonetization would bring back some of the pent-up demand which has so far been away. In fact, in CPI inflation, most of it has so far been visible in perishables and vegetables.
Yeah, that's brought down the headline number.
And that's brought down, and that always is so if I see the CPI and if I see the drivers of inflation, which tend to provide the volatility in the number, it's food. And within food, the protein-rich categories like pulses has seen a consistent pickup in inflation, and with a better harvest this year, we are now seeing inflation coming down there. But in case of vegetables, which generally drive up or drive down the headline number quite significantly, because there tends to be an outsized, for some reason in certain parts of the year, there tends to be outsized change in prices of vegetables. And in the current scenario, I think it's been on the downside. So I think, and on the services side, on the miscellaneous categories, if you take away food and if you take away petrol and diesel, which falls under miscellaneous categories, you've seen correction in prices is not in tune with what is so that there I think their supply rigidities come into play. You've seen in case of housing, health, urban amenities and other services, there are preset price cycles. So there's not much change which happens there. So I think the impact on inflation of remonetization would initially be seen through food prices, and there I think the upside, as the governor pointed out today, the upside risk is close to 1%.
Could there be a downside risk on that housing segment? I know that's part of core and it's been very sticky.
Now,
if price is correct, and
now downside risk, in fact, on housing there is an upside risk considering the HRA adjustment.
Oh, the HRA adjustment on the 7th Pay Commission.
Has to be implemented.
So there's no hope that
I don't think that will. So I think that core is driven by larger supply and demand dynamics. On the supply side, it's among other things the quality of infrastructure, the quality of the amenities, the quality of I think your taxation policies, and then the fact that it's largely a closed sector. I mean, it's not tradable. Most of these services are not tradable. So as a result, import prices will not bring them down. So to that extent, there is this stickiness. And then on the demand side, if you see, especially in urban services, where pace of income growth has been fairly steady, even adjusting for inflation over the last couple of years. There is, I think, enough demand to hold inflation at levels where they seem to have settled down. Clearly, core inflation has been extremely sticky at around in the range of 4.6 to 4.8. You look at over the last 2 years, the number hasn't really budged.
Just moving to the growth side, Gaurav. So they're talking about a sharp rebound. Is that the word that they've used? But I mean, the numbers from 6.9 to 7.4.
6.9 to 7.4 does not necessarily characterize. I would not put the word sharp recovery to it, but clearly it's moving in the right direction.
Maybe they meant quick.
Maybe it's that, but I think RBI has always been, I think even in December policy, RBI sounded far more balanced view on growth. In fact, and that's something even the economic survey pointed out, that the recorded GDP numbers may actually not look as bad because the informal sector is essentially estimated. Informal sector activity is estimated through things like IIP, which again is more formal in nature. So
but tell me, doesn't that informal sector activity then start to weigh on consumption, right? It does, right?
Yes,
so eventually it will get captured.
It does. In fact, the CSO estimate of last year's growth is based on only 7 months of data pre-demonetization. So it definitely will have an impact, and that's why perhaps the remonetization would bring back a sharp pickup in consumption, which has been pent up over the last, let's say over the last, I would say, I think till about December there were a number of areas or number of uses where you could still use old cash, and I think as the economic survey did a excellent analysis of the actual currency in circulation versus transaction demand for money. I think it didn't look as bad.
Yeah.
So there will definitely be some pickup on account of remonetization. I think that's one. I think, and in general, from the government side, I think there's a very clear push towards more capex.
Yeah.
And with the budget having been advanced to Feb, I think from 1st April onwards, you will see money coming in or money being channelized into government projects, which should also allow a pickup, because in the last year or so, last couple of years or so, it's really the government spending which has been the driver of overall. If you see in terms of contribution, it's really government spending which has been one of the key drivers or delta in terms of driving growth. So that would help as well. So I think recovery in private consumption, some pickup in government spending, or clearly, and in fact the impact of the HRA readjustment will also be fairly large.
Okay.
And I think, but the concerns are on the export side. Right? Clearly, there is
export and private investment. So I was just going to going into export. Private investment remains dead for all.
So that is the other area where the twin balance sheet problem comes into picture again. Bank loans and the corporate sector. But then I think with a pickup in activity, it should have a positive impact even there.
Yeah. Just a last question, and that brings us to exports. What are sort of the outlier events that could, take us away from this path that we're talking about, where inflation stays between 4 and 5 and growth stays probably somewhere between 7 and 7.5? Is it this global scenario, trade?
I think it will be largely, at this point in time, I think the major risks which come to an economy of, we are largely a domestically oriented economy. Engines of growth are private consumption and government consumption to a large degree. Exports, yes, over the last 2 years, I think the contribution of net exports in certain quarters has been positive, especially with the drop in oil prices and exports kind of holding off. But then going ahead, I think from the global environment, I think one key challenge will be the increasing volatility in capital flows.
Okay.
At a time when our current account deficit is likely to kind of go up. So which means some degree of financing challenges of the current account deficit, and as a result, pressure on the currency, which in turn has impact on inflation, which which ways with oil prices kind of clearly moving up from where they were last year, and if not heading higher, settling in a higher band. I think to me at this point in time, those seem to be the main global risks, and let's see how the policies of the Trump administration, especially towards the Indian IT sector, how does that affect our IT exports?
And you're fairly confident on the domestic side that this demonetization effect will be transitory. We have enough data to be fairly confident
not
there?
At this stage, I think, but going by the fact that we've not, things, if you see some of the high frequency indicators like the PMI.
Yeah, that's picked up.
It has picked up. So
car sales have picked up.
Car sales have, between December and January, there has been an improvement. Interest rates are lower, far lower. So lending and demand has, so I think it will definitely help in the pickup in consumption, especially in cash intensive sectors where it's largely, consumption is driven largely by cash.
Okay.
even as we've seen some substitution of cash for non-cash or non-cash uses of settling transactions. But I think that's a slow process, but we're heading in the right direction. But I think the very fact that we are a cash economy, some estimates suggest that of the total transactions in the economy, again, they're close to about 90% of transactions happen in cash.
Yeah.
So I think it's a moot point. The moment
cash
money
comes
is back
back,
in the
people
system,
will transact.
People who were holding back will, especially in the rural areas, in the hinterlands, I think that consumption will come back, and that should show up, especially in things like fast-moving consumer goods to start with.
Just summing up, Gaurav, good, bad, ugly. I know that a lot of people in the bond markets are saying this was ugly. As an economist, you're saying it's good.
I would say, I would use the word RBI. Well, borrow from the RBI's stance. It's neutral.
It's neutral.
Yes, I would not even choose good, bad, ugly.
Okay.
I think it's neutral.
Okay. Thanks so much for Gaurav for chatting with us. Do follow BloombergQuint.com. We've got all the latest on the policy and the analysis on various issues, the economy and also the banking sector. Thanks for watching.